Welcome back, folks. This is our dollar index. This is the daily chart. And take a look at what you have here. And I'll add the annotations in a moment. But the price delivery for the dollar index took us down into this move here, this price move up. So we're going to focus in on this swing low, because in this swing low there are details which leads to greater insight, and also why I commented last Wednesday about not wanting to be so heavy-handed in selling dollar and being long foreign currency, because it was more or less long in the tooth with this move here. So all of this is the focus of the dollar index discussion today. All right, so here's our annotations, and you can see the last down close candle, that's our bullish order block, and this green shaded area here, that particular range, I will detail that when we drop down into the 8-hour chart. So we're looking at the reaction here, and we traded right back up into the volume imbalance in here, then shot a little higher back into the top of the premium end of the BISI here. So this is the BISI. The premium end or high of it is this candle's low, and the discount end of it, or the low of the BISI range, is this candle's high. So you can see we came right back up, traded back into these levels here again. And that's going to be important when we drop down to a lower time frame. So let's move on the idea that this is likely to go sideways for a little while, with a likelihood of potentially trading up into the remaining volume balance that is here. So the volume imbalance between this candle's close and this candle's opening, notice you have a little bit of a wick here and a little bit of a wick there, but didn't completely close that in. So just when we drop down in lower time frames, just be mindful that that's probably going to be a draw on liquidity for this week for any upside. Okay, so once we get a determination whether we're going to be bullish or bearish on dollar intra-week, it may start off right on Sunday going into Monday, or may require Monday or Tuesday's trading to do it. But it's not a absolute. It's not a it's going to have to happen, or anything of that nature. It's just a likely draw on liquidity, and if things line up intraday, time of day and day of week, and other factors are supportive of that, then I'll be looking for this area to get traded up into. Much in the same vein as I outlined on Wednesday, that we would trade back up into here and not to be looking short on dollar. Now, what led me to believe that that was likely to happen? Let's drop down into an 8-hour chart. All right, so here's our 8-hour chart, and we're looking at the low right in here. That's that daily swing low. I told you that we're going to mine that for some details. Now, again, it's important that you understand by watching the previous ICT Mentorship midweek review from Wednesday, and that just is going to have to be the 10th. Okay, so yeah, June 10th recording. And you'll hear me talk about how we've already moved a lot, try not to be overzealous and look to sell dollar, and we could potentially see it bounce. Well, what led me to that decision and prompted me to say those things? Well, obviously it's experience, number one, but secondly, it's right in here. I want you to take a look at the volume imbalance that exists in here. So yeah, we have some candle tails here, and a candle wick here. And it wasn't until this candle here that we traded completely up inside of this volume imbalance. Now, we did trade back down with almost a complete rebalance, but we left a small little gap in here. That, to me, might be important if and when we ever trade to this volume imbalance, and if we reject and start to go lower, that would be a level I'd watch for some sensitivity. But it's so close in proximity to the low, I would normally look for this to, if it was a bullish scenario, just coming back down into here, that would be enough, and never running to low. That would be one condition that could lead to a bottom picking for me. Okay, but I'm not trying to say, and let me make it very clear, I am not calling the bottom in dollar. And I'm not saying that we're going to go and run out this high either. We're still inside of a large range between this low and this high. So just be mindful that the focus is this volume imbalance. We rallied through it, okay, and the very next candle, did it leave or go above this volume imbalance? No, but it does it here on this candle. So this is what happens when the algorithm changes its state or mode of delivery. Okay, it's very important that you understand that when we look at order blocks, volume imbalance, mitigation blocks, breakers, all those types of things, there's an underlying narrative that takes place that you're just not going to be aware of unless you study with me. So if we know that this volume imbalance is lacking both buy and sell, it is offered the buy side with this up close candle here. The next candle, it's very, very shallow above this candle here, 96 even. The very next candle here is 96.01. So is that leaving the volume imbalance? No. That's just small little 1 pip deviation above the previous range. It has to leave like it does here on this candle. It absolutely leaves the volume imbalance. So in its wake, what has happened? The volume imbalance only has been offered buy side. In other words, a candle that moved up through that range that is defined by this candle's close and this candle's opening. So when we take this range, again, this is not supply and demand, folks. Okay, Sam Seiden does not know anything like this unless he's in the course, which I don't know. If you are, hi Sam. But nonetheless, the projection extension into time, we go back to the 3 elements of our range of a gap, or in this case a volume imbalance. Okay, so we look at the top or the premium end of it, which was going to be this candle's close. That price is exactly 9,600, and this candle's opening, which is 95.47. Okay, so you have your premium end and your discount end. Then you find a midpoint of that. A midpoint of an order block is the mean threshold, but this is not an order block. This is a volume imbalance, which is a gap by nature. So any midpoint of a gap, I call that consequent encroachment. There's some lessons in the core content, and there's lessons in the commentaries that discover more basis and conceptual ideas around volume imbalances and gaps. But the idea is, if we're ever trading down to a volume imbalance or a gap, the high end of the gap, the midpoint of the gap, and the low end of the gap, or as we label it, the premium, consequent encroachment, and discount levels. Now there's 3 specific price levels there, folks. It's not a demand zone where you're going to, what do you do with that zone? Again, this is not supply and demand. There's specific price levels that I look for, and depending upon the condition of the marketplace, the present market structure, what I'm looking for, day of the week, time of day, relative strength analysis, all of those things factor into which one of these levels I look for. Okay, but to keep things very simple, if you're working with higher time frames like this, you want to be looking at the sensitivity at the top of that. It may not go down to consequent encroachment, which is the midpoint, and it may not ever go down to the discount end of that gap either. And again, as I've been teaching in recent commentaries, it's better for these ranges to never really fully close in, because it gives you insight in terms of magnitude, directional bias. It helps formulate a basis for your trust in the move likely to ensue in the direction that your trade's been organized around. In other words, it should give you more confidence that you're on the right side of the marketplace if these gaps don't completely fill in. Well, as you can see here, price does in fact hit the consequent encroachment, and it's Wednesday, so we saw the reaction after that going into Thursday and Friday. Thursday we traded right up into the volume imbalance on the daily chart, and then on this 8-hour chart you can see we have a small little SIBI here, sell side imbalance, buy side inefficiency, back to a bearish order block, which is the last up close candle, that green candle, before the down move. This displacement is all sell side. It's rebalanced with delivery going on the upside or offering buy side is what it means. So in other words, every price range between 99 to 100, if there's a price run that starts at 99 goes to 100, in efficient delivery of price, the algorithm will at some point, and it doesn't have to happen immediately, but over time will return back to 99 Now, it can happen in a fast-paced return, or it could be a staggered, slow, lethargic return back into it. That movement of up and down, that is efficient delivery. That is the basis of what the algorithm is trying to do. But there's times when the market creates opportunity for it to create an imbalance in price. And that speed and imbalance, which is seen here, 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 and here, where there's big ranges, one directional, and you can clearly mark out a range that it worked between a high end and a low end. It creates that imbalance, and those imbalances, the algorithm will want to go back and revisit that. And that's all that's happened here on Wednesday. And that was the basis of why I was telling you in Wednesday's review not to be heavy-handed on selling short dollar, and this is the basis of seeing that. So when you go through your charts, you want to cycle through all the available time frames. Even though for brevity, I go through usually 3 time frames. It's the daily chart, something lower than that, and then something lower than that. And now because we're doing a seek and destroy on the folks in here that are trying to share my content, you all are seeing different time frames and different commentaries. Now, right away, some of you are going to be wanting to send me emails. It's not fair. I'm not seeing everything. This is not as described. Okay, just know that this is only going to take me a few weeks to do this. Okay, because these folks in here are doing this and sharing my video, or they're reteaching it, and they're going to say something that I'm saying in your video. This video isn't going to say the same things as the other ones. Now, they're all going to say the same directional bias. Okay, so if I talk about a upside or downside delivery, or where I think it's going in terms of up or down, they're all saying the same thing. I'm not doing the old con job of half my mentorship will be told it's a buy, half my mentorship will be told it's a sell, and in that way, if I'm right, at least I get to keep half my mentorship. No, that's not what this is, folks. I'm trying to weed out the weasels and rats in here. Okay, so there's snakes in the grass, and I'm keeping the lawn cut short so I can find them easily and crush their heads. So when we look at these levels, it's important that when we identify them on the higher time frame, we transpose those to the lower time frame charts, as we see here. For the daily, these are levels that were comprised and derived from the daily chart. So in this 8-hour chart, we can see further refinement and things that would otherwise lend well to the things that I teach in the core content. Let's drop down to a lower time frame chart. Okay, we're looking at a 30-minute chart, and this chart here really shows you the buy side liquidity pool, which we've seen purged on Friday, and we have a remaining buy side liquidity pool up here and above this high up here. So 97.80, and we have that daily volume imbalance that's being shown here. Look at what has happened in the 30-minute chart here. Okay, we had a consolidation and a leaving of that. So once it broke this high here, all of this is what you would look for it to run higher to another higher time frame daily PD array. And what does that mean? Something on the daily chart that's higher than this price level here. What would that be? Well, you have equal highs here, then you have equal highs here, but that's on the 30-minute time frame. On the daily, we have that volume imbalance, which is that shaded area up in here, which also is this gap that never really quite got filled in. So we went here and here, and you can hear me talk about that in previous recordings, but it looks as if it may want to go up into this area. So I am, in the beginning of the week, as we start off, I'm looking for a dollar to still try to make an attempt to get up to the 97.60 to 97.80 level. And the reason why 97.80, because it's institutional, and it's also would sweep these relative equal highs, and the highest high in between is here. All right, so revisit these two levels now with me. These are our BISI levels from the daily chart. We traded back up into it inside the range between the high and the low of that BISI, and then we went lower. It went lower. Look where it goes into. This. Now, people that understand some of the things that I teach will think that, okay, well, it's going to come all the way back down and fill all this in. No, it should not do that. It should not do that. This back and forth price action in here, that's a nice, efficiently balanced price range. So when it trades above it, this area here is the only point that is in need of rebalancing, because it left the range here. So that small little pocket of price action only on the upside, that one portion right there to its close, and then the next candle it trades down to there. So it creates an imbalance that needs to be filled from here down, which is what it does. Okay, so this right here is a very, very strong support level because of the underlying characteristics that I've outlined here. The consequent encroachment of the bullish order block on the daily chart, but inside that bullish order block, there's more detail with the gap, and then the consequent encroachment of that gap, again, which is that shaded green area. So you can see beautiful precision there, and then consolidates. This is the top of that order block. Okay, the opening price on that last down close candle on the daily chart. It's accumulating more orders here and runs. Once it breaks above these highs, notice how this is not running above equal highs and going lower. Okay, think about what I'm showing you here. When is it running above equal highs and then rejecting and going lower? When the market's bearish. But we had already dipped down into something that changes the state or mode of delivery for the price. So even though it's dropped down in here, and a quick glance at the chart would indicate that, hey, look, it's been going down, so therefore it should keep going down. Not when it gets down to a discount like we've done on the daily chart. So again, go back and watch the video on Wednesday and you'll hear me talk about these things, but the details behind all that is what's being shown here. So the market comes back down, touches the bullish order block, again touches the bullish order block, which is that level here, okay, 96.10. That level is the level I actually talked about in the recordings, the last weekend review. Okay, so just again, go back and listen to it. It's all there. And then when we leave this consolidation, this rebalancing takes place there. Where at that point should it reach for? Well, easiest is above these relative equal highs. Then we have a small little imbalance right up in here. See how the market creates this big down close candle? It comes back up a little bit, but doesn't quite close that in, does it? No. So we can look for it to trade back up into that high and this candle's low. And you see it does it right there. Blink. And then we retrace. In here, right in here, there's optimal trade entries. 1, 2, 3, that's a buy. And then from here, 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 that's a buy. Or here, here to here, that's a buy. Okay. This one's the strongest one. And why is it reacting so strongly? Because you can see that returning back to the bullish order block with its wick and taking out a short-term low right there. That is the ideal optimal trade entry. Your best ones are always when you're trading in sync with the institutional order flow, bullish or bearish. That's basically what I'm saying. And you are taking out sell-side liquidity if you're buying, or taking out buy-side liquidity if you're shorting with an optimal trade entry. And then it reaches up into logical premium arrays. This is a logical premium array, relative equal highs, and this high to this high. So we're looking at potentially, and we want to see, this is what I'm going with going into the beginning of the week. I want to see if it does have a willingness to want to keep going higher. And again, I'm not trying to call a return back to a full dollar or 98 or 99. All I want is 97.60 to 97.80. Okay, and then I'll assess what we're going to look for from that point on. All right, let's drop down into another lower time frame chart. All right, so here's the 15-minute time frame, and you can see that optimal trade entry right here hits it there beautifully. Projection up, 2 standard deviations, you would get out right there. And it doesn't need to get to your ultimate target or the target I've outlined thus far in this video. All right, so let's go over to the euro dollar. All right, so here's our euro dollar daily chart. And you can see we had no willingness to want to go any higher than what we've seen so far. So look at the bodies of the candles in here. Okay, it's respecting the mean threshold of the body of this last up close candle. This is a bearish order block. And what we do is, or I do, and as I teach, is I want to look at the body because that's the bulk of the volume, okay, the majority of the trading volume, and the wicks or the tails of candles, okay, below the candle is a tail, above the candle is a wick. Those are considered for other principles in my content. But we're looking at order blocks for the discovery of its mean threshold. We always use the bodies of the candles. Okay, so I get a lot of questions. Why do you always look at wicks for some things and candles for, or bodies of the candles for other things? It's the premise of looking for refined entries with optimal trade entry, because there's times when you can use the bodies of the candles for really more refined entry points, and you're not factoring in the erroneous distortion that you can get with the tails and the wicks in the candles, because all of this is generally attributed to what your broker, okay, will do. Because if you look at the opening price and closing price and highs and lows across all different brokerage firms, and you can do that very easily with TradingView. They offer Oanda data feed, and they offer Forex.com, which is what I primarily use for all of our discussions and commentary. But for instance, like I have an account with Forex.com, and my son has an account with Forex.com, and he's on a different server than I am. So his high on some candles is slightly off from mine. But the bulk of the body's candle really comprises the entire narrative that we do here in my Inner Circle Trader teachings. So don't get hung up, and I answer probably 200, 300 emails a month with the same concern. Is my broker screwing me because my wick isn't exactly what yours is? Well, that's normal. And when you sign up with an account to open with live funds and you trade with them, you're giving them permission to do that to you. Okay, that's how they make their business. They're making a market for you, and in that capacity, they're offering liquidity or attacking their own in-house liquidity. Okay, which is cannibalistic in nature, yes, but you agree to that when you sign up. That's what that long form is, all those things and those risks and stuff. So not only do you have to be right about beating the market and timing it correctly, but you also have to know where they're likely to have a run on internal or in-house liquidity. So they have a own pool of liquidity that they can work within. And it used to be rampant years ago, 15, 20 years ago. It was nuts. Like you weren't able to really do very well in Forex right away because they were running bucket shops, and they would just really open the spreads up enormously, and it was highly illegal, okay, unethical. And that's why really that same, I guess, opinion of Forex has stained the industry for such a long time, and we're slowly working our way out of that. But it's nowhere near like it used to be. It used to be like a slaughterhouse where you're almost guaranteeing you're going to lose your money going into a brokerage firm, because they would open up the spreads and just completely take you out, and it wouldn't even nowhere near be trading near that. It was bad. But now the wicks and tails, okay, are just small little, I guess, nuisances. If you don't know what you're doing, if you try to get too ultra tight with your stops, they can still open up and get you. But if you're working with the bodies of the candles, and again, the bodies of the candle, expand that out in time, which is the middle point, mean threshold, look how it's respecting it here and here. So the candle's closed and the candle's opening. Again, this level was explained to you in the last two recordings before it happened. And while we didn't get any further upside, which is what I was leaving room for, remember I was saying it doesn't make sense for it to stop here, okay, and not go a little bit further at least, and try to make an attempt to get to the rejection block, because that's about an 80% likelihood of happening. And I also made very clear that 80% is certainly not 100%, but it's something I always look for it to happen. Wednesday's trading didn't go any higher on Thursday. We broke down. So I said, okay, well, I got to change gears. And what is it likely to do? And adding that to the dollar commentary I gave you, we were looking for that volume imbalance on the daily chart. So it's a modest upside bullish bias to dollar, but again, balancing that with not trying to pick tops and bottoms. It's very, very important not to do that, because I've lost fortunes doing that. Live money, I'm not talking about demo trading. I've lost fortunes trying to pick bottoms and tops, and it took me a long time to finally let go of that and say, okay, well, I don't need that. I'll let the large institutions put the tops in and put the bottoms in, and I'll work within the order flow after that. And there's nothing wrong with that. It doesn't mean I'm not good at trading or that I'm just like retail. It means that I know what I'm looking for. Okay, and that's what this mentorship is designed to do, help you formulate what you're looking for. So anyway, with that in balance, let's look at how we reacted in here and the retracement on the daily chart. The only thing that really stands out to me that is of any importance is right in here. There's a small little fair value gap right there. Now, if we get any further upside on dollar and weakness on euro, we could see 11.55, 11.50 in that area, which is about 100 pips or so. Now, is it going to be a straight shot run into it? I don't know. I don't know if there's going to be any complete return to it down there at all anyway, but it's also very close to this old high back here. So the rejection block on that candle is 111.42 and 3 pipettes. So it could go, beyond that fair value gap a little bit and touch this candle's close. So that's something that you could anticipate potentially happening again if we get upside on dollar and follow through. All right, so let's drop down into a lower time frame chart. All right, so here's the 4-hour euro dollar, and here's that mean threshold line extended out in time. You can see how we just worked around it a little bit and then broke down. Again, that's not supply and demand, folks. That is my order block theory in work. As it's being worked in here, they're working that mean threshold, allow more opportunity for people to do what? Accumulate new longs, and then they attack the sell side liquidity right in here. On Friday, I gave you guys an idea on what to look for a breakdown, and I actually showed my trendline phantom in operation before the fact, showed you exactly what was going to likely happen, and I put a little video up there, and where the light bulb was, I wanted you to be thinking about that low. Now, everyone in my mentorship that has been trained under me in terms of looking for low resistance liquidity runs and the understanding of where trend lines are used for trapping traders because they think these diagonal lines are supporting price or propelling price higher or lower. And that is the biggest nonsense that I've ever seen in retail trading. They don't support price. It's just something that just exists by randomness. I mean, that really is randomness. The randomness of trend lines working consistently. Okay, that's what that is. But there is a consistency of them failing when you understand the underlying narrative. So that's what I want to do is I want to look for moments when the retail universe sees a level and thinks, okay, this is going to be a buy. And I look for it as a sell. But I wait for it to go up a little bit in their favor, go into a premium array. There's your SIBI. Okay, SIBI. Last up close candle, the big beefy body one, that's your bearish order block. So between this and your SIBI, fair value gap rather, this run up into this candle here, 113.40. It rallies up into that. And then once it does that, it convinces traders thinking that, extend lows out and this is going to be a buy because it's a hypothetical trend line. Okay, banks, large institutions, large traders, they do not believe that a line connected from one low to another low, extending out in time, that future level here is going to constitute a real buying opportunity. That's not how this works, folks. This really is not how it works. It might look like that a lot in a lot of books, and you can go back in hindsight and find all kinds of examples of doing that. But I will be able to show you more examples of them failing when you understand the logic and the narrative that's really in play. And they fail more times than they work. So if they fail more times than they work, isn't it more appropriate for you to study when they exist, when you have a better understanding of where the price is going? Then it creates a much more favorable likelihood that trade is going to pan out because you're wrestling or arm wrestling with retail, with the basis of institutional order flow behind you. So who's going to win in that argument or that arm wrestling match? Okay, Hulk Hogan in his prime or Pee Wee Herman? Come on. I mean, everybody's going to, it's the Hulkster. What you going to do when institutional order flow runs wild on you? And I'm an 80s kid, so that's where I got that from. Anyway, we're looking for the reasons for why it went down below this low here. So let's go drop down into a 15-minute time frame, and I'll give you a little bit more detail about what took place in the euro and why we were right about it on Friday. All right, so here's the euro 15-minute time frame, and we're looking at the delivery of price that trades up into this candle right there, and we're going to draw that out. All right, so the market trades up into this area here during the retracement of this total price swing here. Okay, and then we have a smaller one in here. So we have two nested optimal trade entries. This high to this low, this high to this low, back in. So there's multiple ones in here under the premise that this low was going to be attacked. So below this low, what would be resting in terms of orders? It would be sell stops, because the reaction was it's been going higher. Traders that are long, they put their sell stop below old lows because they think this is going to be support. As you can see, the market made real short order of that supposed support level. And I want you to take a look at the low in here. All right, so the low is 112.41. Okay, 112.41. Now, how do you calibrate objectives for reaching for liquidity? So if we're up here, okay, and we're looking for a run below this low, and I'm going to counsel you to go back to my Twitter feed, and that little light bulb was right below this low. So 112.40. So 112.40 is the actual 10 level, but what's the price there? It's 41, right? So how do you work with that? Well, if we're above it, coming down, you want to see it obviously trade to 40 because that would be below the actual low. Okay, and it's a 10 level. But how much further below that? Well, since it didn't go to 40 on this low here, it went to 41, we have to calibrate up to the nearest 5 level. Now, this is one of those moments where if you're just listening to me and you're not taking notes, you are missing the benefits of being in the mentorship, because I'm actually teaching you what everybody else out there does not know. Okay, this low, you add 5 pips to it. So what do you get? 46, right? 112.46. Now you round that to the nearest 5 level. What's that mean? It's 112.45. That's calibration. Okay, so 112.45. That's your real level. So 112.45, if we change that here, by having your level 112.45, and I know I could just simply swipe that away and type in the numbers, but I have OCD, so it is what it is. Now, since we have this level here at 112.45, what's 10 pips below that? Because we're going to be doing grades of sweeping below this low here, and we calibrated our level. So 112.35. Okay, so 112, and I'll do it this time because I know some of you are going crazy. Why don't you just type the numbers in, Michael, and just be done with it? That's 10 pips, 20 pips, and then 30 pips. I'll change that to blue just so there's a distinction there. Okay, so that's our level. That it's being worked in from an institutional level. Remember, we work at 0 levels and 5 levels. And whenever we calibrate, we either calibrate to a 0 level or a 5 level. So if we're up here coming down, this is the level to watch, and then you do your pip grades of 10, 20, and 30. 30 pips takes us down into a low of 112.12 in 7 pipettes. Okay, some brokerage firms would even allow you to get out at that with the spread. It's not even important. Okay, this is the part where you allow your analysis to be right, but your trades, you just want to get out at the easiest one below that low, which would be what? 40, easy. That's the low-hanging fruit. Exit if you're short. Then the next one will be 10 pips here. Knowing that you could potentially trade this far down, but do you really want a chance getting out or not getting out because of the spread? And you allow the market to trade the additional 10 or 20 or 15 pips. That's how I've arrived at my exit strategy. It's not perfect. It's not in any capacity of being perfect. I have logic behind me that I know these levels exist. I know they're likely to trade to it. But when you have money at risk and you're putting the trades on, you want to be able to pull it out and know that you're getting out and not be caught in a reversal that may take place, or hold on to a trade demanding it gives you that final 3 pips. How many times you've been in a trade and you did that? You know you should be getting out, and it just looks like it's not trying to get to your objective, but you're in your mind wrestling saying, but if I cancel my trade now, I didn't follow my plan, and that makes me a weak trader. Wrong. Pay yourself. Pay yourself. You're the trader. Pay the trader. All right. So that's the business on Eurodollar. Let's go over to cable. All right. So here's the British pound daily chart. And we did get that run up into the tail here and the midpoint of that, which is consequent encroachment. That's a gap. We trade up into that on Wednesday. I said, let's see if we get any kind of willingness to go any higher. And if it did, we would see a potential run in here. Now, if we get a reversal on dollar, say dollar breaks down this week, then my objective goes right back to here first and then in here. All right. But for right now, if we see continuation on the upside, say the dollar really ramps up. Okay. Say the dollar really drives higher. We have a fair value gap in the form of a BISI, buy side imbalance, sell side inefficiency, that is defined here. So you have 3 levels to be watching now. You want to see if it's going to dip below the low at 124.78. Consequent encroachment, which is the midpoint. I'll let you do that on your own. And then the low end, or the discount end of the range of this BISI, buy side imbalance, sell side inefficiency, which is this candle's high here, comes in at 123.94. So let's take a look at this on a lower time frame chart. All right, so here's the 2-hour chart on the British pound. You can see how we just fell short of hitting that 128.20 level. The high came in at 13 and 2 pipettes, so just about 7 pips short of that institutional level. Then we had a break in market structure here, right there. We created an imbalance, comes back up, rebalances there, and then attacks the sell side liquidity resting below these relative equal lows. To the left of that, what do we have? We don't have any kind of real fair value gaps in here, except for the small little one in here, but it's just not that big of a deal. But we have the low here. There's the sell side liquidity. And then we are entering into an area where it's real close to what? That BISI on the daily chart. And we can see how we dipped into it just right here on this one particular candle, trades into it there, and look at the reaction there. Running the equal lows, which we do here, we come right back up into those relative equal lows and a fair value gap resting right in here. Look at the bodies of the candle, how they're respecting that. The wicks are the erroneous price action, okay, in the sense that it's exaggerated. Focus on the bodies of the candle. It'll give you the narrative of what's going on. Rebalances the small little SIBI, sell side imbalance, buy side efficiency. And what I'm saying is that one single candle right there, the range that is between this candle's low and this candle's high, extend that out in time, you can see it hits it right in here. And then that's why you're getting that reaction there. That's where the banks are dogpiling in to go short. And then they ride it down, taking out the sell side liquidity here. And we have that daily BISI, buy side imbalance, sell side inefficiency, where that one single big candle went up. That's what I framed in between here and here. So inside of that range between this line and this line, what do you see? You have another BISI, one single candle. So this can be further refined to here. And I'll change this to, let's go with an ugly color. That way it stands out. But that's my favorite color, Michael. Sorry. All right, so there is the other BISI that's now been redefined, and then you would just simply take your fib and run it over there, and you can see that the fib level calls for 124.29 6 pipettes. So that would be consequent encouragement, and that would be a downside objective should we see continuation on the dollar index on the upside. It's dropped down to another lower time frame on cable,